Hey everybody, it's Mr. W here, and I'm going to do a video for you on depreciation basics. Now, depreciation is a topic that is covered in Unit 1 in Telepath in the long-lived assets lesson. And they do a pretty good job of going through that with you, but I do want to give you a little bit more on this area because this is one of those areas that sometimes students will struggle with a little bit. Now, this particular handout is available if you look down in the description box underneath the video on YouTube. I provided you with a link to this document as a PDF file. And if you want to follow along with me, and if you want to do the example problems along with me, you're going to need a copy of this document. So now would be a good time for you to pause the video and grab a copy of that if you need to. And then when you have it, you can resume the video and pick right back up with us. So let's talk about what exactly depreciation is, first of all. Depreciation is when you have a long-lived asset, which is something that we're going to use in the business for many years, and that item is going to decline in value over time because of usage, because of wear and tear, and so forth. So the example I've given you here is a new car. So let's say we go down to the dealership and we purchase a brand new Toyota Camry off the lot, and that's going to be used as a company vehicle. Let's say the cost of that vehicle is $32,000. So at the time we purchase the vehicle, we're going to record that on the books at $32,000, which is what we paid for it. But the problem is 6 months from now, that car is not going to be worth $32,000 because it will have gone down in value because it's been driven for 6 months. So we need to have a way to take that decline in value into consideration when we are doing the books and when we are preparing financial statements. And that is where this comes into play. So the first thing we need to talk about is, what do we need in order to figure out the depreciation on an asset? Well, you need three things to do that. You need to know what the asset cost you. You need to know its useful life. And you need to know its salvage value. Now, depending on the resource you look at, sometimes salvage value will be listed as residual value. That's basically the same thing as salvage value. So we need to know all three of these things in order to be able to calculate depreciation. Now, the assets cost is fairly easy to obtain. You would simply look at the invoice or your purchase receipt to see what you paid for it. These other two items, however, are going to be determined by the company's management. So we have the useful life and we have salvage value. Useful life is, how long do we think we're going to use this asset in our business? So depending on the asset, maybe we think we're only going to use it for 3, 4, 5 years. Some other assets, like maybe a building, we anticipate we're going to be in that building for the next 70 years. So this is something that management will determine. Now, salvage value is when we get to the end of that asset's useful life. What are we going to get out of it? By selling it, by selling it for parts, whatever the case may be. This is also something that management is going to determine. So the key here is both of these are estimates. These are estimates made by management at the time we put the asset on the books. And as is the case with many estimates, they're subject to change. So maybe we purchase an asset at the very beginning and we think we're going to use it for 6 years. We get 3 years down the road and the asset is performing very well, and we think, no, we'll be able to get more than 6 years out of this. Maybe we'll get 8 years out of it. So we can always change the estimate of these two things. These are not necessarily set in stone. But the key thing here is they are estimates. So once we know these three elements, the next question is, how do we calculate it, or what are the different methods we can use to calculate it? Now, if you're watching this video, chances are you're in my Accounting 202 class. So in Accounting 202, the only one that you really get into any practice with in IntelliPath is going to be straight line depreciation. So that's what I'm going to cover in this video. However, there are other methods that we can use. There's declining balance, sum of years digits, units of production, and you may have seen those listed in IntelliPath, but you're not really going to do much with those in this class. However, you may see them come up in classes down the road. So I will be doing a part 2 of this video to go over these three methods. This video is only going to focus on straight line because that is what's covered in Accounting 202 here. All right, this is the blueprint entry for recording depreciation. So whenever you're doing a journal entry to record depreciation on an asset, we're going to debit depreciation expense, and we're going to credit accumulated depreciation. All right, so anytime you do a depreciation entry, it's always going to follow that format. Now, depreciation expense, as the name implies, is an expense account. It's going to be listed with the other expenses on the income statement. This one, however, the accumulated depreciation is a little bit different of an animal for you all. Accumulated depreciation is what we refer to as a contra asset account. Now, what on earth does that mean? That means accumulated depreciation is going to reduce the value of a corresponding asset. So let me give you just a really brief example here. Let's say that we have that company vehicle we talked about, and that vehicle cost $32,000. Let's say that we have taken accumulated depreciation, which is what the A/D is, of $10,000 so far. Well, that $10,000 is going to reduce the value of this vehicle, which is going to give us a value of $22,000, which is what we would report on the balance sheet. And you're going to hear me talk about this a little later, but this is called book value. Okay, so that's the amount that we would use to report this asset on the balance sheet. All right, now, based on all of that, let's put this into practice so you can see how exactly this works. So we have a scenario here. XYZ Corporation purchased equipment costing $88,000 on January 1st, 2022. Management estimates the equipment will be used in the business for 7 years and will have an estimated salvage value of $4,000. The company paid cash for the equipment at the time of purchase. Now, can you identify the 3 elements that we need to calculate the depreciation in this scenario? Well, we know the cost, we know the useful life, and we know the salvage value. So those are the 3 elements we need. As long as you know what those 3 elements are, we're good to go. Now, one thing about salvage value is you may run across situations where an asset may have no salvage value, which is fine. That happens. So don't get thrown off if it says there's no salvage value. So we need to do some calculations. The first calculation is we're going to calculate something called depreciable cost. Now, depreciable cost is going to be the original cost minus salvage value. So in this particular instance, we know the asset cost $88,000. And we also know the salvage value is $4,000. So if you do that subtraction, that means the depreciable cost of this asset is going to be $84,000. Now, depreciable cost is the portion of the asset's cost that we're actually going to depreciate. Now, let's go down to annual depreciation expense. So the formula for calculating this is your depreciable cost divided by the useful life. And since we're doing this annually, we're going to use years, but you can do this by year, you can do it by quarter, you can do it by month. You're not locked into only doing it annually. You can do it for whatever time period you want. So if you're doing it by quarters, then you would divide by the number of quarters in the useful life. If you're going to use monthly depreciation, then you can divide by the number of months in the useful life. But we're going to use years in this example. So we know the depreciable cost. We just calculated it up here. It's $84,000. And we're going to divide this by the useful life, which is 7 years. So $84,000 divided over 7 years is $12,000 per year. So that is our annual depreciation expense. So when we do the journal entry for the depreciation at the end of every year, that entry is going to be for $12,000. So let's do some journal entries. So the first entry is to prepare the journal entry for the purchase of the equipment on January 1st, 2022. So this is not a depreciation entry. This is the entry that we would need to record for the actual purchase of the equipment. So we're going to enter the date, and I'm assuming this is the first entry for 2022. That's why I put the year in there. Now, don't forget when you're doing journal entries, we always do the debit portion of the entry first. So in this case, we are going to debit the equipment account since that's what we purchased. And that's going to be for the cost, $88,000. Now, we have a debit, but every journal entry must have both a debit and a credit. So we need to credit something. Well, how did we pay for this equipment? They paid cash for it. So we are going to credit cash for $88,000. So simple entry to do the purchase of the equipment. So now let's start looking at the depreciation adjustments. So remember earlier I gave you the blueprint entry, which is a debit to depreciation expense and a credit to accumulated depreciation. So now we need to do the depreciation entry as of December 31st, 2022. All right, so let's enter the date. And go back and look at the blueprint. We debit depreciation expense. And we credit accumulated depreciation. And that is going to be for the amount of the annual depreciation that we calculated on the previous page, which is $12,000 a year. So depreciation expense debited for $12,000, accumulated depreciation credited for $12,000. Now, the next entry wants us to do the same thing, but as of December 31st, 2023. Well, here's the nice thing about straight line depreciation. You're converting the cost of the asset to an expense evenly over its useful life, which means if as long as we continue using this for a full year, this amount's not going to change. So December 31st, we're going to do the exact same entry that we did up here. So a debit to depreciation expense for $12,000 and a credit to accumulated depreciation, $12,000. The next one, as of December 31st, 2024, again, because it's straight line, we're going to do the same entry for the following year. So debit depreciation expense for $12,000 and credit accumulated depreciation for $12,000. Now, this with the journal entries being the same year after year, that is something that is unique to straight line depreciation. You're not going to see that with the other methods that I'll cover in part 2 of this video. Now, the last thing is determine the book value of the equipment as of December 31st, 2024. So let's review the formula for calculating book value. So book value is the original cost minus accumulated depreciation. Now, don't get confused right here. This is the original cost. That's not depreciable cost. So we go back over here and we look at the scenario to see what did we pay for it. Well, we paid $88,000 for it. Now, what about the accumulated depreciation? Well, we bought this equipment January 1st, 2022. So we've had it for 2022, 2023, 2024. We've had it 3 years up to this point. And each year we have banked $12,000 of accumulated depreciation. So $12,000 times 3 years, that's $36,000 of accumulated depreciation. So we take the original cost and we subtract out the accumulated depreciation, and that is going to give us a book value of $52,000. And as a reminder, that book value is going to be the reporting amount used for this asset on the balance sheet. Because on the balance sheet, we always report long-term assets at their net value after depreciation. So that's why we take this accumulated depreciation out. And that, ladies and gentlemen, is straight line depreciation. So I hope you found that video helpful and that you had no problem with the examples. If you have any further questions about this topic, please reach out to me, and best of luck to you in your future studies.